You're watching The Sharpe Angle. I'm Leslie Picker. Engine number one was founded a year ago and since then has made quite a splash in the investing world. It took on Exxon in a proxy battle and won 3 board seats. It launched an ETF that was focused on ESG and more recently published a white paper focused on GM, applauding its move in electric vehicles. So what comes next? For more, I'm joined by Jennifer GRANCIO, the CEO of Engine number one. Jennifer, thank you very much for being here today. So I want to dive right in and ask about your theory of change. As I just mentioned, you have a lot of buckets that you're operating in: activism, ETFs, constructive research, maybe more that we don't even know about yet. What do you think is the best way to achieve the means to the ESG ends?
Yeah, thank you, Leslie. We think the whole idea of the firm, we founded Engine number one on the simple idea that you have to understand the relevant E, S, and G data. And then you simply use that to think about what are companies valued at today, are they misvalued, and how do you drive economic value over time? This data is critical to long-term value. So we start there. And then in everything we do, we also engage very deeply with the companies. So our point of view is, if you care about ESG, you want to engage with the companies to put them on the right path. And if you're just investing and you're looking to build wealth and have strong performance over these transformation cycles, you care about ESG data. And you also really have to engage with the companies. You have to hold them, and we don't believe in divestment. Maybe we can talk more about that later. You have to hold the companies and engage with them so you can help them over the transformation cycle.
So I want to home in on this word engage because Exxon, it was more of a critical engagement. You looked at a company, you felt like they were doing potentially bad things with regard to ESG and sustainability in particular. With GM, you're engaging, but in more of a complementary way. Are both of these strategies, you think, effective? Is there one that you're more focused on than the other?
We actually think there are a lot of different ways to engage with a company. And so everything we do is based on a total value framework, which is this idea of when you look at a company's business and you look at their material impacts, how does that then relate to what the company's value is over time? And so when we look at Exxon, we saw a problem. It's an outlier. So from an E, an S, and a G perspective, the company was making choices that were leading to negative long-term value outcomes for shareholders. And so that's a case where maybe the company doesn't see it that way. And as investors, you really have to engage to think about how do you do something differently. In the case of GM, the company actually understands they have a good CEO, they've got a great governance approach to running their business, and they understand the E and the S, and they're using it to drive value for shareholders. So they're two very different examples. So in a case like Exxon, where it's an outlier, you may, as investors, and we feel like we were able to go and make this argument, make an economic argument, be the sort of tip of the spear on this conversation, and a lot of people came with us and followed us. We took an activist approach. In most everything else we do, we think it will be much more of a constructive approach, like what we do with General Motors.
It's interesting that you say that because after the Exxon campaign, a lot of CEOs across corporate America were studying their ESG chops, worried that they could be vulnerable for the next situation. Do you feel like you can use that halo and do something similar in the future on the activism front because you were so successful with Exxon that now you have kind of the wind in your sails to do a next campaign?
Well, the way that we think about it for now is we have information, we have a way of thinking about the world where we can actually help CEOs. And what we found on the back of the work with Exxon is that CEOs want that help. So many CEOs, they have ESG reports, they have studies, and a lot of them, frankly, would love somebody to talk to help think about what are the key things in ES and G that they should think about. And we think that's really the magic, which is doing the math and figuring out which of these impact areas are most critical to a business, and then how do they engage so that they actually drive value for shareholders over time. And we've had great conversations with a lot of CEOs where we're not coming to be a threatening activist. We're coming to be deeply constructive about how they run their companies and make money for investors over time. And GM's a great example of that. If you think about it just from a performance perspective, only from a performance perspective, A lot of portfolios have leaned into growth. They've leaned into technology. So the portfolio is full of technology and growth stocks. In the biggest companies in America, we have operating companies that understand engineering, they understand manufacturing at scale, and they've been doing innovation for a long time. And so if you take an example of GM, we're now at a place where the cost curves on battery technology and electric vehicles have come down. And if GM can get investors to come with them and allow some immediate investment so that they can scale in these areas, that creates an environment where they're making 10 million electric cars a year compared to, say, Tesla. We love to talk about Tesla, right? Tesla, huge multiple, but only not that many cars a year, right? A tenth the number of cars for GM. And so this is a huge opportunity for investors, and it's a huge opportunity for CEOs to just make it more about the data and the math and long-term shareholder value. So, we've had great conversations with CEOs.
Interesting. Recently, your head of activism left the firm, and if I'm reading between the tea leaves, it sounds like proxy battles are not going to be the norm for engine number one. Am I understanding that correctly?
We think a lot of the opportunity is very constructive. And so again, the opportunity for CEOs to get to the nub of how they make ES&G part of their, basically just running their business. They want to do that. We think that's a huge opportunity for investors. So that's right. We may occasionally need to do a proxy campaign or an activist campaign, but mostly we're going to be constructive.
So it's not fair to call you an activist investor?
It's fair to call us an investor that's trying to drive performance for everybody that we work with.
There were reports out there that you met with Chevron and some of the other executives from the oil and gas industry. Anything materialized from those conversations that you'd like to share?
We've talked to a lot of people, and so our point of view on that whole sector is that companies are working to figure out, as we go through an energy transition, how they manage their business for optimal returns over time. So we don't comment on exactly what we've done with who, but we are having a number of constructive conversations. And again, we think it's a big opportunity for energy companies and a big opportunity for investors to get this right.
What do you make of Exxon's recently announced goals to reduce company-wide greenhouse gas intensity by as much as 30% by 2030? Are they going far enough?
Well, we're glad Exxon is starting to make some progress on these issues since we started the campaign a year ago. But our perspective is still that it's a company that has work to do on governance and work to do on sharing with the market a strategic plan over time for how their business transforms. So we'd like to see more there, and we're happy that we were able to lead a campaign that puts the right capabilities in the boardroom. So there's an opportunity to have that conversation now.
What does that conversation look like? When you say more, what do you mean by that?
Well, we're not in the room, so we unlike other people that would sort of be the lead on something like this or a campaign, we didn't put ourselves in the room. We found what we thought were the 3 or 4 best directors out there to be in the room, running successful energy companies, managing through transitions, and so that takes time. It will take time for the company to embrace, hopefully, we're not in the boardroom, but embrace and have a conversation as a new board about what the strategy should look like.
If they don't get to where you need them to be, would you be open to running another proxy battle at Exxon?
Well, we'll be watching them.
You've taken a different approach, as you mentioned, with GM. This was a white paper, largely complimentary of the automaker, saying that they're a leader among incumbents to make the transition to electric vehicles. Is this something that we're going to be seeing more of? And will it always be related to sustainability, or will there be other research on maybe the social part of ESG or the governance part of ESG? What are you working on now?
Yeah, and our point of view on this is that all of those things matter. So governance, how good is your board? Does your board have the right capabilities? Are the people on the board people that have successful track records in running prior businesses? The governance matters. And then from a climate perspective, it's just a little bit right in front of our nose because companies already have disclosed a lot of information. And so it's very easy to have a math and economics-based conversation about how environmental relates to long-term value. And on the social side as well, and the data is on the come on the social side. So we use the data that's available today. And there are clear causalities and relationships between how a company brings people up through leadership, perspectives and how a company thinks about their impact on the community, how a company thinks about the quality of wages for their workforce. So absolutely, those are all areas that are in our sights.
So if you were to kind of speak broadly to CEOs out there, which of those S factors would you say get that in order right now, or you may be receiving a call from us soon?
Yeah, I think it's a little bit different for every company depending on their business and where they have the most impact. So if you're a professional services firm, how are you bringing people up through the leadership ranks? If you're a firm that employs people at average lower wages, are you employing people in a way where they have more than a living wage and you're hiring in proportion to the communities that you serve? So it's a little different for different companies. But our guidance would be think about materiality. Think about running a business the right way so it's sustainable and you're serving customers and you're kind of beating out your competitors over time. So make it about that long-term economic value, and it makes it much easier, we think, for companies to do the right thing.
Are there certain sectors that you feel like are really up to snuff when it comes to ESG and those that are particularly lagging?
It's never one sector over another, and I mean, there obviously, from a climate perspective, there are businesses that have more emissions, and so those are, from a climate perspective, that's more relevant. But it's different in every sector, and we'll talk more about that as we go through time. And the other way we've structured our business is we have launched this ETF vote. And the idea there is, a large cap product that people can invest in at a super low cost gives us a vehicle where we can work with all those companies, we can work through those companies over time. So to your point, you're optimizing how companies think about these things, regardless of what industry they're in. And then in the vote product, we vote every single year. And so we're very unimpressed with the historical record of investment managers and how investment managers have used the ability to vote every year on behalf of their investors. So that's a big priority for us, and that's something we're spending a lot of time on.
I want to talk more about the vote product in particular, because I was looking through some of the top holdings and I was looking through performance. It really matches the S&P. By and large, the performance matches the S&P, the top holdings match the S&P. What's your goal there in particular? What are you hoping to achieve with that ETF?
Yeah, so the VOTE ETF, and we call it VOTE, VOTE's the ticker, the engine number one transform ETF, is about a vehicle for people to hold the largest companies in the US over time. And so if you think about anybody from the biggest institutions in the world to retail investors, if you think about creating wealth over time, you want to hold the market, you want to be diversified. And so we've created a product that does that. Our belief when it comes to value creation with ES&G, or value creation in general, is you don't divest from the market. So some of the early ESG products they use negative screening. So instead of holding the market, you say, I don't like oil and gas, I'm going to divest. I don't want to hold any company that has anything to do with fossil fuels. The problem, if you do that, is all of those investors are now not working with any of those fossil fuel companies to hold them to account and help them go in a direction where actually probably they're doing a lot less damage if that's what you care about. And so our perspective is you don't divest, you hold the market, and the VOTE product simply holds the largest companies in the US market. And over time, we have an opportunity through that product on behalf of the people that invest with us to hold those companies accountable. And often that's not in a bad, scary way. So GM's a great example of that. GM is doing the right thing. And as long-term investors, we want to support GM in making this transition. As GM makes that transition, it has a hugely positive effect on climate, as well as, if you didn't care about climate, it should have a huge impact on driving up their multiple and creating value for investors.
So you're not divesting. What's your criteria then for those companies that get to be in the index?
Yeah, so it's the index. We're not screening them in or out based on their immediate behavior, but we have the opportunity, because we own them and because we have the votes on governance and E and S proposals every year, we have an ability to hold those companies to account. Something else we're doing on vote, which we've heard this a lot from investors, which is the big indexers that are out there in the market today. They do some things well, but people don't even realize they have a vote. And that's a problem. So we're creating a product where you know you have a vote, and then different than what anyone else is doing. We're being very transparent about every single vote. How are we voting? Why did we vote that way? So that people can actually understand how we're engaging on their behalf with these companies.
Hence the ticker symbol VOTE.
That's right.
How do you think ESG investors should be looking at China right now?
I think China is hard. And so in the case of the US companies, for example, we have a system where we can hold the companies accountable. There's a system with US public companies around how governance work, how boards work, and what the rights of the investors are to have a conversation with that governance system. The market in China is different.
In terms of, obviously the structure is different, but would you say that an investor who's looking at investing in ESG and making a bigger impact with their ESG footprint, can they screen out China? Should they be screening out China entirely, given, some of the issues involving human rights over there, involving people disappearing, things along that front?
I think I would say that a different approach may be required in markets where you have a point of view from a values perspective and you don't have an ability to work with a company to drive change.
So because of that, are you all primarily focused here in the U.S. in terms of your engagement?
We have started in the U.S. because the U.S. is such a huge part of all global portfolios, and so the U.S. is the natural place to start. And also we think a lot of American investors aren't sure yet on what do they do about ESG. So we have a strong a tradition in the U.S. of you make your money first and you do something good later. And we don't think that makes sense. We think that the public is going in a different direction. The public wants accountability. They want to be purpose-driven. And if you're running a big company, you want to run the company in the right way so that the company is sustainable. So our business is starting in this market where we have such a huge opportunity to invest to make money, and while we're at it, to kind of integrate the doing good and the impact at scale.
Broadly speaking, what's your prediction on ESG? You talk about the data and you talk about the total value framework and the way that you're thinking about ESG investing. It's become an increasingly popular space over the past 2 years. Do you think that all gets consolidated? Will there be some sort of ESG shakeout where, we do see people who are successful at doing this and people who are maybe less successful at doing this and are more concerned with kind of the marketing wrapper that goes into these types of products?
Our hope is that this conversation becomes performance driven. And so if it becomes to your question, is it about marketing or is it about lingo? No, it's about using our votes, using our modeling. We're investors. We invest on behalf of the people that come with us. So it's our responsibility to understand how these factors drive financial performance. And so we would like it to become more core and more integrated, but people really have to understand it first. So we're going through a transition where we think a lot of managers don't totally understand the relationship between the data and performance. We do, we've built our business around that. And so we want to sort of lead the industry in thinking about that's the right way to do it. It's not here's your portfolio and here's your ESG. It's you integrate it so that you're building value over time from a financial perspective. And we think that's the right way. So we hope that we're here to kind of push the industry in that direction.
I know you all are long-term thinkers, so we will be watching. Only a year behind you, but still you've done so much. Jennifer GRANCIO, CEO of Engine No. 1, thank you very much for taking the time.